Welcome everybody. We got Dan Golden with CrossCountry Mortgage. And of course today we're going to really kind of get you guys geared up for 2022. It's hard to believe. It's right around the corner. We've been receiving a ton of questions. In fact, it was funny, as Dan and I were doing our kind of weekly follow-up, he was talking about some of the pitfalls that people are going to run into. And we said, you know what, let's go with the top 3 so that you guys can go into 2022 really with a running start, and to make sure that everything you have in place is going to allow you to be the winner of your next offer, because multiple offers, we're still seeing escalations.
Yep.
We're not slowing, we've slowed down a tad bit as expected. Seller activity as far as new markets come down as predicted, but the pent-up buyer demand is still there. So if you are well priced, you're still going off market in 7 to 10 days, very, very quickly. All right, so with that, Dan.
Yes.
All right, 3 financing pitfalls 2022. You said credit score was one of the top ones, with the caveat, trade lines.
Right.
What does this mean?
So credit score is obviously a very important criteria when approving someone for a loan.
Okay.
There's all kinds of loans that allow for lower credit scores, but when you get into some of the jumbo category, they really start looking at trade lines. So you can have a really good credit score, 700, 750, 800, but if you only have 2 trade lines, it might preclude you from qualifying for certain jumbo lending.
Okay, so let's time out real quick. For those of you that do not know what a jumbo is, what is a jumbo loan?
So a jumbo loan is a category above the conforming limit.
Which is?
And the conforming limit is 648, but it's county specific, and King, Snohomish, and Pierce have what's called high balance.
Okay.
And that goes to 891.
All right. So we have 891,000.
Right.
Anything that is above that,
yes, is a jumbo loan.
892,000.
Yes.
Is a jumbo.
That's a jumbo loan. So if you get into that category, there's just a extra criteria that the jumbo lenders look at, and some of the really aggressively priced jumbo lenders have really tight guidelines when it comes to some of the things we're about to talk about.
Okay, so when we talk about trade lines specific, because you and I had a really good conversation about this,
right?
What does the normal person, let's say that they normally have a gas card, and I have a debit card. Okay. Are those my 2 trade lines? Is that good enough for me?
A debit card is not going to be a trade line. It's anything that would come up on your credit report. So a credit card, a car loan, a mortgage, a gas card that's based on credit, a store card, a Nordstrom,
like a Home Depot,
Nordstrom. Those are all going to come up, and they want to see at least 12 to 24 months of history on those.
Okay.
So like someone could go out tomorrow and go apply for 3 credit cards and have 3 trade lines, but you have to have a history of those. So they want trade lines with a history of at least 12 months.
So minimum 12 months.
Right.
Okay, so if I have 2, I'm going to go for a jumbo.
Yep.
Okay, I'm going to go for a jumbo loan. So I'm going to have, so let's take, for example, we listed a property. It went under contract at $1.5 million. I'm going to put 20% down. That's going to make me a jumbo. I've got a credit card and I have a home mortgage right now. Okay.
Mortgages count for a little more, so you probably would be okay because you have had a mortgage.
Okay.
But if you don't have a mortgage, if that's a car loan and you have a car loan plus one other trade line,
right,
they're going to want to see another trade line, or you're not going to qualify.
Okay. So what if I'm a tenant? I rent right now, and I don't have a car loan, but I do have a credit card.
Not enough.
It's not enough. What's going to happen? I'm buying a $1.5 million house. Okay. I've got my 25% down. Okay. I'm going to increase it from 25% down. Okay. And I have a credit card that I barely use ever. In fact, I haven't used it in the last couple of months because I'm fiscally, I'm smart, right? I've got cash in the bank. Why should I use my credit card?
Right.
Okay. I own my car.
I run into this a lot. Number one, if that's the case, your scores might be low because the scores are based on activity.
Okay.
But if your scores are high, you're still going to be limited. I'm not saying there's not a loan out there.
Right.
So I have a lot of jumbo investors that will allow for it.
Okay.
But it might not be the rock bottomest rate that you see out there.
So I'm going to see an increase in rate
Right.
because of my lack of trade lines.
Correct.
Ah,
And
okay.
the reason behind it is the investors are like, we don't see a payment history there. We're gonna give this guy or this couple $1 million loan, and we don't know how they pay their payments.
So what you're saying is credits, your interest rate is based on risk.
Correct.
Okay, so the more
Absolutely.
you can prove that you can pay back your debt, the better your credit score is going to be. So for those folks, and yes, I call it financial blackmail, and I suffer from this, and I get this, and I run into this because like many of you, you're fiscally smart. You don't use your credit cards. You pay cash or very close. You pay things off that are a depreciating item, and you only finance, like a mortgage or a rental property for an appreciating item. But we get punished for this, and that's going to translate into, value of trade lines, especially when we're looking at jumbos, which is becoming more and more common, especially in Seattle and the east
Right.
side and outlying
Right.
areas. Okay.
Yeah.
So how does somebody fix that? If they're right now, if they're saying, "Oh my gosh, Dan, that is me. What do I need to do today to be
I would
ready?"
open up a credit card and I would use it for your monthly expenses and pay it off monthly.
Okay, can I pay the whole thing off
Yes.
monthly?
Yep.
Okay, perfect. So I don't have to keep a small balance every other month.
I mean, it would probably. I might keep a little bit on there, but if you charged it up, paid it off, charged it up, paid it off, they're still going to show, the credit card is still going to show activity on it,
Okay.
and they're going to show that you're making a payment on it.
Okay.
And what's great about that is, I'm assuming most credit cards, you're not paying interest if you pay it off completely,
Right.
and you're probably earning some sort of benefit,
Points or something.
rewards or something.
Right.
So you can actually use it to your benefit without paying the interest on a credit card.
Okay.
So that's what I would do. I would get one or two of those
Right.
and utilize those. Maybe keep $100 balance running just so, and that will build up. If you do have low credit scores because of that, it'll rocket. In
Really?
like a few months, it'll go up.
Okay.
So that helps. Yeah.
So let's cover one more thing. We had one client that did this, bless their heart. So they went out and they got a $3,000 credit card, right?
Yep.
And they maxed that bad boy out every single month, and they paid, almost all of it off. But they'd max it out again, and they paid all off again. Is that not the recommended?
I wouldn't max it out. I would keep it at 30% of the limit.
That's the number that we're looking for.
Yeah, I would keep
So
it
guys,
30%.
if you go ahead and get a credit card, don't tap it.
Yeah.
Don't take it all the way to the top.
And going over limit is like the kiss of death for your credit score. Kiss of death. It'll drop your scores 75 points.
Oh, ouch. So anyway, so keep that in mind. So there's logic. So if you get a
good point.
$1,000 credit card, $300
Yep.
is the maximum, and then of course pay that down. I always remembered, and whether factual or just fictitious, every other month have a small balance so that it shows you can manage debt.
Yeah.
Right.
You
All
can't, I would recommend that.
Okay, there you go.
Yep.
So, all right, so that's number one. So trade lines, especially with jumbos, but trade lines, because remember your interest rate that you were quoted, okay? Not what you see published out there. Okay, like last week we talked about somebody who was offering a 2.69%, and there are all of these limitations, okay? Now, that's not what we're talking about, because that rate, because of the limitations, and if you work with a big box bank, KeyBank, B of A, Wells Fargo, WaFd, all these guys, are they going to pull all the really super important information up front?
No. That's one of the things I see all the time is, they pre-approve somebody and they show this rate, and I have clients come and go, hey, I got approved for this, and I look at their situation, I said, I really don't think you're approved for that. They might tell you you're approved because what the banks do is they have this, the reason they have lower rates is because they don't have very much support.
Right.
So they don't have the upfront support. So basically they have this huge room of processors somewhere in another state. The loan officer takes your application, and the verifications of all that information that you provide happens 2, 3, 4 weeks down the road when
Closer
it
to
finally
close.
gets in their place in line.
Right.
In this massive processing group.
Right. And then we get the last minute, oh, you don't qualify,
Right.
or, oh, you have to put more down, or oh, you have a higher interest rate,
Right.
or oh, sorry.
Right.
Yeah.
And I think we're going to this here, this validation of information.
Right.
And that's the difference between pre-qualification and pre-approval. What I do up front is I pre-approve you. I look at everything. I obtain all the verifications within the first like 5 days, if not sooner. And I can tell you, hey, I know, and you know, a lot of people will tell me I make X per month, and you know, maybe they're just started getting a bonus, for example.
Right.
So hey, I make $5,000 in salary, and I just started getting this $5,000 bonus, so I make $10,000 a month. Well, unfortunately, and that's you're not lying, you're telling the truth, and that's great, and that would qualify you for more. But that bonus has to be, it has to have happened for over 12 or 24 months for us to be able to use it, and that's every lender out there. So you're not going to be able to use that extra bonus until you've had it happening for a while.
What if they change jobs?
If they change jobs, we have to revalidate all that information, and if it's the same line of work, it shouldn't be a problem.
Okay.
But if their pay structure is changing,
Right.
we have to vet that out, and those are things we do up front. And I can tell people, hey, you know, you went from this type of salary position to 100% commission.
Right.
That's another example of, you know, hey, I was making $10,000 a month, now I'm making $20,000, but it's all commission.
Right.
You have to have a 2-year history of earning commission if it's 100%, especially.
Otherwise, you're
Otherwise-
back to your.
Yeah, you have to go. You have to use your salary. That's all you can use.
Wow.
So that's what a lot happens. I see a lot is people will, you know, turn an application into a big box bank. Hey, I make $20,000 a month. Okay, no problem. Oh, you qualify for X.
Okay.
Go find a house, have fun. And then 2, 3 weeks later, 4 weeks later, they get the bad news. Like, oh, we just realized this is all 100% commission.
Right.
I do that up front. So that's the difference between pre-approval and pre-qualification.
So-
and that's only one example.
Right. So pre-qualification, just to let everybody know, that is just you could literally just pick up the phone, talk to somebody, give them some basic information, and they will give you a pre-qualification. Really, at the end of the day, it's not worth the paper it's written on, okay? I'm just telling you. Now, a pre-approval, that means that they have vetted more of your information. They have gotten your down payment, or they've proved, or they have seen proof of funds. They have gotten your verification of an employment or a VOE. You know, they've looked at your bank statements. They've looked at your tax returns, hopefully, okay? Now, here's the thing. Many lenders, because, well, you guys go out and shop all the time, lenders are not willing to put all of that extra effort in to make sure that they're vetting everything to get you to a pre-approval, because they know that you're out, going over here, and that's not time well spent. They wait until you are committed, and then they will actually finish that processing part. Is that a valid statement?
Yes.
Okay. Extremely frustrating for loan officers, extremely dangerous for you. I'm just telling you, especially in today's world where I would say, well, I know I can say, out of the last 20 offers we've written in the last month, very clearly, every one of them had to remove financing and appraisal. That means that to go in and to ensure that you're not losing your earnest money, make sure you and your family are protected, you need to be pre-approved. That means that person, that loan officer, whomever that might be, has to go all the way through the process. When people work with us and they're getting pre-approved through Dan or whomever, they know we require all the way through underwriting. I want it through the underwriter. And understand, lenders won't do it because they know that you're still hunting, you're out there, and so they're not getting that loyalty to say, yes, I'm going to spend, because it costs money.
Yeah, well, that's what the banks do. The banks, they have a process, and the process is to put it into a big machine, and it's efficient,
right?
But you don't get a lot of times you don't get a lot of accurate information,
No.
and that's what's the key, is to get a real approval versus pre-qualification.
And that risk, when you have to go in without financing and without an appraisal protection, without an inspection contingency, no contingency, that is a monumental risk for a prospective buyer.
Absolutely.
If they are not at this point.
That's right.
All right.
Yep.
Okay. And they could get bit by this very easily.
Very easily.
Okay. Let's talk about the next challenge that a lot of people have some confusion over. Down payment versus what reserves are. And then, of course, I just want to tie in at the end, prepaids. Explain to people, because we get this question all the time. What is this
Right.
line?
So when you buy a house, there's a down payment. There's also closing costs, and there's also prepaid, what they call prepaids. Prepaids are your deposits for taxes and insurance for the first year. It's calculated depending on when you close, but essentially they want to see 6 months of taxes, property taxes based on the property you're buying, and a year's worth of insurance. That's a simplistic way to say it. So prepaids are a chunk of money that you pay into basically like a little savings account that sits aside your loan, and then they draw from it every month and pay your taxes. Or excuse me, they don't draw from it every month. They draw from it when taxes are due.
Right.
You pay into it every month, and the balance goes up and up and up, and then they pay your taxes when they come due twice a year, and they pay your insurance when it comes due. So it's kind of like a little savings account.
It is. It's a micro savings account. They can only keep a 10% buffer in that. In fact, every year, like I just received mine, saying, hey, your taxes went up and your insurance went up, and you can either pay this amount or your payment's going to go up by X dollars per month to cover that, so that it's never in arrears, so it's never in a negative balance when they pay your taxes and insurance.
And that money is your money. If you buy a house tomorrow, set up this account, win the lottery, pay off your house, that money comes back to you. It's your money, and then you pay your taxes and insurance on your own at that point.
Right.
So in addition to a down payment, you have what's called prepaids. That's those deposits we're talking about, closing costs on the loan, and then on top of that, and this is where we were going with
the reserves,
the kind of pitfall, there's also many loan programs require what's called reserves. And what that is an amount. It's usually represented at a certain number of months of your full mortgage payment. So if your full mortgage payment is $4,000 and you need 6 months reserves, 6 times 4 is $24,000. We have to show that you have, after your down payment, after your closing costs, after your prepaids, you have $24,000 in reserve, sitting in an account. We don't collect it, we just have to see it.
It just has to be there.
Yep.
What if it's in stocks, or does it?
It can be in stock, 100%.
Okay. All right, so can I show that in my retirement account?
Retirement, they reduce it by 70%. So if you have $100,000 in retirement, they're going to give you credit for $70,000. Again, you don't have to liquidate anything. We just have to show it, and then we take, it's a retirement account. We're going to take 70% of that, 70,000. You need 24. You're fine. You're golden.
Okay.
But we have to show
Pardon
that.
the pun there, right?
Yeah. Get that all the time. So many lenders require 0 to 12 and some even 24 months of reserves. Not very many are 24 months. Pretty much 12 months is caps out, especially jumbo. Jumbo lenders all require reserves, at least 6 months of reserves.
Okay.
So that's another thing when you're looking at a jumbo loan. You're buying a $1.5 million house. You want to put 20% down. That's $300,000. Oh, I have $300,000. Here's my account.
Right.
Well, you need closing costs, you need prepaids, and you need reserves to show reserves.
Okay.
So there's extra funds that you need to be able to show in addition to just the down payment and closing costs.
Okay. Now, like you mentioned, this is not on all of them, but it is on many of them, especially when we hit the jumbos.
Almost all jumbos require it.
Okay.
But below jumbo, there are certain loans, conforming loans, regular Fannie, Freddie loans.
Right.
A lot of them don't necessarily require reserves. Some will.
Okay.
Some will require 2 6-month reserves for you to trigger an approval.
Okay.
So it depends on your credit profile. So if you have a low credit score, for example, they might say, okay, we want to see 2 months of reserves because you have maybe a mediocre credit.
Okay.
That's an example.
All right.
So that's,
or not enough trade lines.
Or not enough trade lines. That's
Okay.
the same kind of thing. Yeah.
Perfect. All right. For the people out there that are looking at and struggling to buy a home in these multiple offer situations, what would be the number one recommendation that you would give to them right now?
Be pre-approved. Go through the lending process.
Be underwritten.
Be underwritten, pre-approved. Go through the process to make sure you have a letter that says, I am underwritten, approved. And then along with that, for me at least, we can close fast.
Right.
That's another benefit to it.
So for the folks out there that have been led astray as to what they, for a loan program that they can get, okay, and maybe they're in panic mode right now because, oh my gosh, how do I close? And, I need to close in 11 days. Okay. Do you have an 11-day close program that would help them?
I do. Wow, it's funny you mentioned that. I do have one of those, but you do have to go through the pre-approval process before you make the offer.
Right.
So if you make an offer and you call me today and say, hey, I want to do the 11-day close, I'm making an offer today, I might still be able to do it. We'll have to really get some things rolling today.
Okay.
But for the most part, I need a couple days to get your pre-approval going, and then
To
you
do
can
that.
go make that offer.
Let's take it the other way. Somebody was in the process. They're getting a denial from their big box bank, or maybe it's an online bank, which we have seen unfortunately multiple times.
Yep.
Can they reach out to you? Are you able to do something in a condensed timeline to help them out?
Yes. Once you apply with me, I can move really fast in getting you that pre-approval.
Okay.
I just need to make sure that you're sending me what I ask for quickly.
Okay.
So
Paramount, you need accurate
Right.
information.
yes.
Okay.
And
Fair
it's
enough.
pretty easy to obtain, and most of it's pay stubs, bank statements, tax returns. Sometimes not all. We don't always need tax returns. Bank statements, pay stubs, and then we pull your credit. Those are the things I need. But I will go through that with a fine-tooth comb
Right.
and get it in front of an underwriter very quickly, and you be able to go out and make that offer or complete your offer that you are in trouble on.
Right. Super cool having everything in your own office and
right.
having your own team.
Yep.
Your team rocks, by the way.
Thank you.
Yeah.
Thank you.
Candy, you don't ever like Candy. Candy, don't ever leave Dan. You're never allowed to leave Dan. You rock. All right. Okay, so 3 pitfalls you need to avoid in 2022 to be the most successful. If you have any questions, reach out. We do answer them within about 30 minutes. Maria will go ahead and post the 5 questions you need to ask when getting quoted rates. That is a super important video. Also, she'll post Dan's information, so if you have a question, you can feel free to ask him direct. And again, he gets back very quickly. You guys have an absolutely fabulous week. It's Wednesday. I will be chatting with you guys probably Saturday for a market update. And I'll talk to you later. Dan, thanks again, buddy.
Thank you.
It's always
Good to
good.
see you. Happy holidays.
You too. Merry Christmas, everybody.